Yeah, hey, it's Mike Swanson. I'm here with David Skarica at his place in the Bahamas. And we just did that video yesterday. We were talking about gold. But what are your thoughts on other commodities like oil, the grains? You know, in the summertime, we had a nice rally in the grain markets, and oil prices are back up near their highs. What do you think is going to happen with oil this year, or in other commodities?
I think two things is, number one, that's where I think the long-term trend is in, and that's obviously kind of the thesis and overview of my book, that I think that this commodity bull market, which we've been in since really about 2000, 2001, is going to continue on, and that's actually where you want to be longer term. And then secondly, you mentioned the grains, is that I have these trading strategies I use for these commodities. Like I owned some of the large cap agricultural stocks, and I own the RJA, which is, it's an index fund that kind of tracks a lot of these agricultural commodities. So when a lot of these commodities are beaten up, I'd like to buy them then, because I think we're in this long-term upcycle where everything's going to move higher in commodity prices. So whenever reason for some specific sector or individual commodity gets beaten down, I like to buy them. So for example, last summer, I was actually really looking at the grains, and now you're talking about what I like now. Now I kind of still, and I've liked it for about a year and a half, I really like natural gas, which has kind of been stuck in the $4 to $5
Well, it's
range.
one of the few commodities that hasn't had a nice rally in the past 6 months.
Yeah, and we've seen it now starting to firm up, and actually a lot of the natural gas companies are looking very good. Like they've got the bases building, and it looks like they're just starting now to come out of the bases. And I like some of the energy stuff. Obviously, still like the precious metals as a long-term hold. But, you know, I really, really like some of the natural gas stocks here. The problem with playing a lot of these individual commodities via the index funds is you have the rollover and the erosion and all these sort of things. So sometimes that's not the most efficient way to do it. But I'm just telling you, like a lot of these natural gas companies right now, and I have one in my list in particular, are trading at, single-digit PDEs, yielding 2, 3, 4%, that sort of thing. So that's where I like right now. And I like to be very conservative with it. And again, look for a commodity that's, for whatever reason, is not moved yet. And as long as the fundamentals behind it are strong, kind of get into it, and then you have more leverage to the upside because you're coming from a low level.
No, it makes a lot of sense to me, and like we're saying, the one that looks like that now is the natural gas. What's the ETF? UNG, I think?
UNG,
and there's another one too, but I can't remember what it is.
But like I said, I actually like the stocks better than these, because the stocks you actually get dividends.
That's right.
And they've gotten to the point, they have a valuation contraction. So a lot of the stocks are trading at 8, 9, 10 times earnings as well, which actually usually commodity stocks tend to trade at higher valuations. So they get those kind of valuations is really, really fantastic. So I don't know if natural gas is the kind of thing that would move like in the next month. But definitely over the next 2, 3, 4 years, at the current levels, you're probably going to do quite well in it.
And the thing about the commodity stocks too is, since really the beginning of December, there's been a nice pullback in them.
Yeah.
Whereas most people I know, in the United States, are focused on buying Apple and big name stocks. Like we're watching this morning, CNBC.
They're just talking about Citicorp.
Yeah, they're talking about Citicorp earnings, and that's what most people really get caught up in, is these kind of things where we really think, they've had nice runs the past year or two, whatever, but from going forward next couple of years, they probably don't have a lot of upside. But so the real opportunities for people really in things like these commodity type stocks.
And just to finish off here, the one thing I mentioned in the last video is why I think this bear market, if we're not in a bear market, but when we do have a bear market in stocks, it's going to be different than the last bear market, in that the last bear market was kind of this deflationary bear where everything crashed in 2008, commodities included. And my opinion, on this bear market, it's going to be different. Everyone looks at the last bear market and portrays that going forward. Like one reason people were buying real estate was because they thought real estate would hold up in bear markets because they held up in like the tech bust. Mm-hmm. And that obviously was a myth when real estate all fell apart in the last bear market. Now people tend to think that commodities and everything's going to go down with the market. See, but my own personal opinion is the next bear market is going to start the funding crisis in the United States. Like interest rates spiking and inflation coming on and the dollar decreasing is what's going to start the next bear market. And under that scenario, the dollar going down will be bullish for commodities. So, okay, when the first sell-off comes, commodities might sell off with everything because people will think that's what happened. But I think at some point, it's just the opposite. These rising commodity prices and rising inflationary pressures is what causes the bear market. So this is why I'm telling people that I know it's tough to look at 2008 and think that, you know, you want to be in commodities in a bear market. And what we got to remember though, even in 07, 08, until the big kind of panic came, commodities were holding up and going up while the rest of the market was going down. But definitely in the next bear market, I think that commodities are going to hold up better and even maybe go up. And commodity prices going up might be one of the reasons for the bear market when it finally does ensue.
Well, let's assume we get a bear market like that.
Yeah.
That's really driven by interest rates going
Yeah.
up. That's something that will take time to develop.
Yeah.
You know, it may take 1 or 2 years, because if you look at bonds right now, to me, you know, we've seen bonds drop in value.
Yeah.
Recently, the past couple months, and even with the Fed saying they're buying the bonds.
Yeah.
And I think that's a shift from a bull market in bonds that's really been there since like 1980 to maybe a secular bear market, and it's only just starting
Yeah.
to happen. So you can have the bond prices go into a bear market for a year or two before the stock market follows suit.
Oh, totally. Like, if actually look at and this, we'll end off on this note, in the last secular bear market for stocks and bonds actually prices peaked out in the mid 50s and stock prices peaked out in 1966. So bonds were actually going down for a decade before the equities began their secular bear market. So I'm not saying that has to happen this time around, but but definitely, like, really bond prices has been going down since December 2008. So, okay, maybe rates are still historically low, but, bond prices have topped out for over 2 years and the equity markets had this huge rally. So I think at some point, higher interest rates are going to negatively affect the stock market, but it could take a while for that to play out. And just the final note on commodities, when higher interest rates happen, people think that's going to be bad for commodities and gold because there's higher rates. But just look what's going on in Europe right now. If people think that, people are going to buy treasuries because they're 8%. Right now, people are worried about Greece being solvent and Ireland being solvent. They're not running to those bonds just because they yield 8%. Remember, the reason the rates are going to go to 8% is because there's going to be perceived risk in the U.S. government. So people think that gold's going to go down because 30-year treasuries are 8%. They're wrong, because people aren't going to want to even be in treasuries at that point because they're going to be worried that they even get the interest back on their money. So that would actually, higher interest rates, I think, in my opinion, are going to put more people into commodities and gold.
Mm-hmm. And that's sort of what you saw towards the end of the 70s.
70s, yeah.
Anyway, we'll talk to y'all later.